Hi everyone. So I'm sorry for putting this video out a little bit late to start with. So what I'm going to do is I'm going to roll in the idea of how we look at revenues and expenses and how we account for them all in one go. So to start with, what I want to show you is just how we go about identifying revenues and expenses a little bit better. So let's have a look at this. This is pretty similar to what I showed you in our last class. So what you can see here is our accounting equation, assets equals liabilities plus owner's equity. So what we need to do is every time we have a revenue or an expense, even just a transaction occur, we need to think about what's actually happening. So if I make a cash sale, well, I'm getting cash. Okay? So I know my assets are increasing. But then I have to think, do I owe anyone any money? Or do I have to pay someone anything? Well, I have a GST part of it. So I've got cash that's GST. And I owe that to the government. So that GST part, we don't consider that revenue because we just have to pay it straight to the government. But this cash that we've got here doesn't go to the government or anything else. It goes straight to the owner. So as a result, our capital increases. So we can say for sure that that is a revenue. Okay. Now you remember I said specifically that if we have a capital contribution, so you could put in cash or stock or inventory, a vehicle, any sort of asset. Now, when an owner does that, again, we don't owe any money, but it does increase our capital. The reason we don't class this as being a revenue is because it's specifically mentioned, so you do need to remember that. Okay? I would suggest maybe having flashcards. Okay, I got a message. Great. I would suggest maybe using flashcards to remember your definitions of assets, liabilities, and owner's equity. And you can work the definition of revenue and expense in as well, being an inflow of economic benefit or an inflow of assets or an outflow of liabilities. And it increases owner's equity. So I really encourage you to keep focused on that. And now let's look at how we actually account for them. So today we're going to focus on accounting for different revenues and expenses, focusing on credit transactions. The main focus on this will be on accounts receivable and the sales that we make. But everything that I say can be applied to accounts payable or the money that we owe. So far we've been dealing entirely on a cash basis, but as businesses grow, credit is often something that we need to offer. So it's important that we understand how we manage these credit transactions and the impact that they can have on the business. To start with, we're introducing a new document. This is our invoice. So normally we have receipts, checks, or EFT details, but with credit transactions, we use invoices. So they always have the following details. They always have the name of our customer, the date of the transaction, the cost of the item and the GST included, the total of the invoice, and also the credit terms, meaning when that debt is expected to be paid within. Now, obviously, if we are selling something, then we'll have a sales invoice. Okay? So this is what we give to our accounts receivable, the people that owe us money, and we treat them as a current asset. So we treat their promise of cash to be pretty much as good as cash. We also have purchase invoices that we receive when we're buying things. In this case, we consider them an account payable or a current liability. Now, credit terms are important because we need to know when our debts are expected to be paid and when we expect people to pay us. So, credit terms are stated in the following way: the time allowed for the payment of the invoice and any discounts that are offered. Okay? So, we could write it like this, where it says 5/7 N/30. Now, this means that a 5% discount is offered if you pay within 7 days. Otherwise, the net amount, the total, needs to be paid within 30. Now, when we are accounting for our sales that are on credit, we can't put them in our cash receipts journal because they're not cash. So we need to create a new journal, and this is called our sales journal. Okay? So when we do expand this system, it's pretty simple to include, but we need the following details. We need to know who we sold to and how much money is owed to us. So for this reason, we have our sales journal. Now, let's look at an example with a couple of transactions in place, and we'll see how these transactions flow through into our record of individual accounts receivable and into our schedule. Now, it's important to keep in mind that when we make a purchase, we have our purchases journal, and we keep similar records of our accounts payable, and we also have a schedule of people that we owe money to. It looks pretty much the same, but instead of being money that we are owed, it's money that we do owe. Okay? So here's an example of our sales journal. We have a payment a credit sale from B. Waldron, which was invoice 1201, where he's bought $2,000 worth of stuff plus GST, and we can see our total accounts receivable is $2,200. Now, it's important that we separate these because we have one column that is our revenue here, and we've also got another column that is increasing our liabilities here. Now, as I said, we do keep individual records. This is a good way to make sure that we are on top of the people that owe us money, and we don't let things go too far, because if we let people spend like 70, 80, 90 days, that's like 3 months without payment. That's going to be a problem for us because we're not going to have the cash. So let's have a look at some realistic data that we put into our records of accounts receivable. So you'll see here, this is for B. Waldron. We've got that $2,200 sale that we made earlier, and they've included a new one, which is invoice 1209, and that is for another $1,000 plus GST. And you can see that on the 28th, we've received cash via EFT. So this allows us to keep track of things, and we know exactly when he's paid and what credit terms he's met. This is important information. It helps us to evaluate whether or not people are good accounts receivable and whether we should continue to offer them credit and things like that. And if people are taking too long to pay, we can stop their line of credit and just make sure that they pay in cash from now on. Now, finally, we have accounts receivable schedules. Similarly, we do have accounts payable schedules. They look very similar. It's just based on purchases rather than sales. So, when we look at our schedule, it creates a list at the end of every month of what's owed to us. And this works really well as a double check method because it needs to match up with what's in our balance sheet. So, what you'll see is a list of what individual people owe, and that needs to match their individual records, and the total of it needs to match your balance sheet. So it's a really good triple check. So let's have a look at an example of this. So here we have our accounts receivable schedule at the 31st of July, 2023. And you can see these four individual people owe us these amounts of money. which totals $10,000. So we can actually check against their individual records and against the balance sheet. Now, saying again, we do have the inverse of this, where instead of looking at sales, we have our purchases. Now, the change comes in that we call the journal our credit purchases journal. We keep records for our accounts payable, and we have a schedule of accounts payable. They're really the three biggest differences. So what we'll do now is we'll wrap things up and go through the questions that you need to answer and finish up. So this is really moving into a new realm of accounting for you guys, where you're looking more and more towards really real world situations. So for this, make sure that you get all the questions done. And if you are having any troubles, please email me, get in contact with me. As I said, I've given you access to that calendar, so you can even make a WebEx appointment with me, and we should be able to get this done by the end of the first week back from holidays. So good luck everyone, and I'll catch you in the next one. Bye.